So last year was the first year that we felt the impact of the new tax laws. How did you do last April? Well, there's some things that we can do between now and the end of the year that might impact and lower your taxes that you pay this April. Let's take a look at a few of them. Have you heard of bunching? We now know that the standard deduction has been increased. If you're single, it's around $12,000 indexed for inflation each year, and if you're a married couple, it's $24,000. And many individuals notice that they haven't really been able to take advantage of their charitable deduction. Why is that? Because as they make those charitable gifts, they don't have enough other deductions to take them over that $24,000 limit. So one of the ideas is to bunch your charitable gifts to organizations like Drexel University. So instead of, say, paying $1,000 a year, why not pay up 5 years, $5,000, take the deduction, and then you wait the other 4 years and then make the gift again in another 5 years. That's called bunching. The other way to do that is to take advantage of a donor-advised fund, such as Drexel's donor-advised fund, where you would put a sum into the donor-advised fund. At the date that you put that sum in, you get to take the deduction. So let's say we set up a donor-advised fund and we put $20,000 in. On the day you do that, you get a $20,000 deduction. Add that to your other deductions and you should be well over the $24,000 standard deduction. So one of the ways that you may reduce your taxes, if you're age 70 and a half or over, is to use your mandatory distributions from your IRA and roll them over directly to a charity. As you know, you're required to take that mandatory distribution each and every year at age 70 and a half. If you take it, you have to pay income taxes on it. What if, instead of taking that, you roll it from your IRA administrator directly to a charity? In that case, you don't include that amount as income, and the government treats that as if you made your mandatory distribution. So by rolling your qualified distribution directly to the charity, you don't include that in income. And by not including it in income, you don't pay taxes on those funds. So another idea is to put your checkbook away and use appreciated securities instead. So here's how this works. If you take a depreciated security, let's say ABC stock that you paid $100 for, and is now valued at $1,000. Traditionally, you'd make a gift to a charity like Drexel, say the $1,000 gift. You'd write a check and you'd take your deduction. Here, the smarter way of doing this is taking that appreciated security and donate it directly to Drexel. Drexel then sells the security. Because we're a nonprofit, we don't pay the capital gains tax, therefore we receive the full $1,000. How much did it cost you to make that gift? $100. It's a smarter way of making the gift. Now you say, yeah, but I like that stock. It might actually go up in value, so I don't want to do that. Well, here's the idea. If you were going to write that check anyway, go ahead and transfer the stock. Then take the check you were going to send to charity, go back in the market and buy ABC stock for $1,000. What have we just done for you? We've increased your basis. So if you sell it for $1,500, as opposed to paying capital gains tax on $1,400, you're only paying capital gains tax on $500. Lastly, here's a way that you can make a gift, take an upfront charitable deduction, and receive income for the rest of your life. In a charitable gift annuity, you transfer funds to the university. You make a gift, say $10,000. Drexel University then enters into a contract with you, and it agrees to pay you income for the rest of your life. The amount of income that you receive is based on your age at the time you take out the charitable gift annuity. When you make the gift to establish a charitable gift annuity, you get an upfront deduction. Now, you don't get to deduct the entire $10,000, you get a portion of that. You also receive quarterly payments. Part of those payments will be tax-free, and part of those payments will be income that you'll have tax on, which gives you an added benefit since you're not paying taxes on the entire amount that you're receiving. Why is that? Because the IRS deems some of the money that you're receiving each year as a return of the principal, a return of the gift that you get back, so you're not going to pay taxes on that. It does become entirely taxed as income once you reach what's called the actuarial age. So if you'd like any more information on any of the ideas that we spoke about today, or any other ideas that might help your year-end planning, please feel free to contact somebody on the gift planning team at Drexel University. Remember, complete your gifts by December 31st to enjoy tax savings. Keep all of your receipts and acknowledgement letters for tax purposes. Donate stock or other appreciated property that has increased in value to receive even greater tax savings. And don't forget to ask your advisor which charitable giving options are best for you.